Hey, good morning. It is June 8th, 2025, and we are looking at a week ahead of stock investing. We had a really good week last week where stocks did have a lot of volatility, but then they came back and really performed well. Overall, last week we were up 2%, and you see the volatility, and volatility is not a bad thing. It gives us really good stock prices to invest in. So I have nothing against volatility, especially if we end the week going up higher. That's always a good thing. So it was a really good week, and we're on a really nice run. The last month, we're up almost 6%. And looking at year to date, I mean, you're not going to time the very bottom, but for anybody who bought some shares on April 8th or around that date, you're up 20% potentially on average. So it's been a year with a lot of volatility, but that volatility an investor can use to take advantage of and buy stocks when they're lower priced. And then you can see your investment go up in value. Who wouldn't want that? So it's been that type of year. And we're now seeing that the market has appreciated 2% year to date. So it's been through a roller coaster already in 2025, and it could continue to go up. But I think we are seeing expensive stock prices. We could see more volatility. I'm keeping some capital around, some dry powder, ready to deploy if I see stock prices really sell off. I'm a dollar cost average guy, and I would like to keep some of that dry powder. So if one of these companies that I want to buy becomes available, I'd love to buy. So good morning, David Jackson. Thanks so much for your support. Hope you're doing well. Let me know if there's a stock you'd like me to take a look at, analyze, or if there's a topic you want me to take on. Be happy to do so. If you guys are new to my channel, drop your phone in bath. Oh, okay. Well, maybe you got a new phone. Hopefully your new phone's nice. Looks like you had trouble with your phone. If you're new to my channel, a couple of things that I wanted to introduce is, so I'm an investor that looks at the value of a company, the intrinsic value defined by the future cash flows that business is going to produce. That's the most typical way that big investors, famous investors value companies. Now, getting to that intrinsic value takes some financial modeling, takes some decision making. And I go through that process. I'll go through that process if a member selects a ticker, or if somebody who's not a member buys a $5 super chat. I could look at a stock and go from soup to nuts, analyze the whole company. We'll look at the desirability of the business. What type of business is it? Is it a highly desirable business? Is it okay? Generally okay, desirable. And then we'll do a full valuation, compare it to the current stock price to see if the stock is being discounted or being priced at a premium. Investing could really pay off, but investing right is really the key. Making good decisions most of the time is the way to make a lot of money investing in stocks. So if there is a stock out there you'd like me to look at, looks like the Great Bambino, I guess referring to Babe Ruth. If you'd like me to take a look at him, be glad to, and Palantir, be happy to. $5 super chat gets you up to the plate, I guess, and I can take a look at those. Thanks for joining my live stream. So moving on some opening comments. So we've got the S&P trading up 2%. Now, not all stocks go up evenly the same percentage, right? Some stocks go up, some stocks go down. And I like to look at and break out the market along its different categories. And I'm going to start with sectors. So every company belongs to an industry. For example, you have auto and truck dealerships, you have entertainment companies, you have banks, and so forth. Every company belongs to an industry. And those industries get categorized into sectors. And sectors tell me generally these big economies. For example, healthcare, materials, communication services, which is a big part of it is Google Alphabet, Meta, Netflix. We have industrials. These are kind of old school companies like 3M and others. Also shipping companies, UPS, FedEx, those kinds of companies. Utilities that in general produce the power we consume. Financials, which include banks and insurance companies and so forth. Now, the reason I like to look at these categories is to see which one of those big sectors is doing the best year to date. And can I find companies that are thriving within that economy? So healthcare right now is number one. That's interesting. Healthcare is made up of pharmaceutical companies, biotech companies, health insurance payers, hospitals, health services providers, pharmacies, that kind of thing. So healthcare, as you may know, is a huge economy, something like 20% of our GDP, which is huge. And it employs a lot of people. And in the United States, we have a very good healthcare system. We've got great hospitals, great qualified people to take care of us when we need to go to the hospital. And within healthcare, I'm going to look at that sector a little more closely, but let me go over the other sectors just briefly. Behind healthcare year to date on performance is materials. And materials is probably being pushed by the gold miners and gold producers. Gold, the price of gold has really gone up, and those gold miners have really done well. The other thing that's helping materials companies is that the tariffs have put steel producers in the US in a really desirable position where they're going to be able to get better prices on the steel they produce that is then used domestically here in the US. So that's also helping. Communication services is Meta, which is doing really well. AT&T is doing well. Netflix is doing great. Netflix is up over 40%. So that sector is doing well. And then the others are behind. Now, the worst performing is energy, oil and gas, and produces with gasoline and diesel, and so forth. Consumer discretionary, the economy hasn't been great for consumer discretionary. Real estate, because I think interest rates did go up, so that hurt real estate. All right, so healthcare is number one. Let's take a look at some companies that are within healthcare that I think are interesting just to examine. So here's healthcare. It's a $4.48 trillion market cap sector. All the companies, if you add them up, that's the market cap. The biggest one being Eli Lilly. Now I'm going to pick out some companies that are doing great, like Abbott Labs is up 18%, Novartis 21%. That's doing really well. Gilead Sciences, another life sciences biotech company, is 21%. HCA Healthcare, McKesson, looks good. GlaxoSmithKline, GSK, looks good. CBS, 41%. Sensora, 28%. So there's some real winners in healthcare. So stock investing is, in big part, it's like a lot like fishing. You got to know where to fish. If the economy for 2025 is going to help certain sectors, then it's good to know that and invest in those because you're going to get a tailwind. You're going to get assisted by the economy. And on the flip side, if you're going to see an economy maybe for the next couple of years where it's going to hurt a sector, then it's maybe important just to know that, rethink, was I going to put more money in there? So um, healthcare, I think, is a good opportunity. There's good value in healthcare. One of the stocks I've been talking about is United Healthcare, which the stock price has been really beaten down, but the business itself is still excellent. If you look at what they do, they're number one in health insurance, very profitable, and they generate great free cash flow. They've grown their top line sales year after year after year after year. They do really, really well, but they've had some bad stories that have affected the stock price around their CEO. And the stories are real, but I'm not buying the stock to buy a piece of the CEO or because I like the CEO. No, that's not the principal valuation method. It's about what are the cash flows that United Healthcare is going to produce. When I examine it, it is highly discounted by like 50%. So I'm really excited about that investment. I'm going to keep buying into it. Shadow Guy, good to see you. I am still on the road. I am traveling through Texas. I'm currently outside of Dallas, and I had a really nice day yesterday. We visited the stockyards in Fort Worth, and my son took in a concert. We did a bunch of fun things, so it was really, really fun. And today we're gonna do some more things, and we're actually gonna go for the first time. Never been to one, a snake farm. Got to see something you've never seen before, and we noticed it. So we're gonna check out a snake farm this afternoon. Um, we'll see what kind of snakes we see. I wonder if they're gonna have a bunch of rattlers or what. But that should be interesting. Thanks for asking, Shadow Guy. And you can tell this is not my normal studio. My studio is better lighting and different back surrounding. This is pretty cool though. I like this hotel. Snakes. Why did it have to be snakes? Exactly. That's Indiana Jones when he fell into that tomb, I guess. All right, back to stocks. This is not a travel live stream. So healthcare is really popping up as potentially a good place. And you think about healthcare, there's some older investors out there. A lot of these healthcare companies tend to be dividend payers. I know dividends are important to some investors so that you could draw out some income. That's where you could see some income coming out of these companies. For example, Pfizer pays 6-7% dividend. It's a really nice dividend. Most of these companies are pretty mature businesses that are slow growers, and they produce really nice dividends. So keep that in mind. And got a new comment here, Commander X. Lynch score and Graham's value. Yeah, let's take a look at that. I'm more of a Benjamin Graham kind of guy. Peter Lynch, I was a huge Peter Lynch fan back in the day. But I'll tell you why when we get to Lynch score, why I don't, I lost my religion of Peter Lynch. So let's try to find what you were referring to. So let me try to do a search here. So we'll go with Lynch first. Lynch score. It's not going to find it. What? Nope, didn't find it that way. So let's go to home. That's trending. And if you could help me out, do you have a sense of where I could find that? Nope. And is it within a stock maybe? Maybe I was overthinking it. Let me see here. It's going to Amazon. Is it like in here? Statistics, metrics. Not in there. Nope. So I'm striking out there. It's interesting to know that they have that out there. I'd be curious to know what's in it. Is it um, a particular valuation calculation? I'll take a look if I find it. But thanks for bringing that up. Ines Esvido from Portugal. Super cool, man. So you're a couple of things that you're saying about yourself is that you're new, starting to invest, and you're an ETF. That's a very good pairing. That's a good idea. And why is that? If you invest in a good ETF, let me see if I can find the ETF you're in. So I think it is the iShares S&P. Okay, so you're in the S&P. Now, that's not a bad thing. It's a good thing. You're accumulating capital, right? Especially when you're in your younger years and you're really focused on making yourself more valuable by, hey, maybe you went to school and got educated, or you're in a trade and you continue to get higher levels of certification, so you get more money, you get paid more money, and you're increasing your worth to your employer. Maybe you started a business and you continue to grow your business and you're creating more monthly and annual income. That's really important to have an inflow of capital. And during those years, you may be new to investing and lacking of time. Maybe you've got a lot to learn. ETFs are a great idea. I was in ETFs and mutual funds for a long time, and over time, really moved from mostly in ETFs to mostly in individual stocks. So when you invest in ETFs, the S&P is okay, but there's not a lot to learn there. I'm going to show you an ETF in China that I invest in, and the reason for it's not to recommend that you invest in it. I never recommend you invest in anything, but it's really just to show you how you can learn from an ETF. Because over time, what I would hope for is that you're always learning, because you want to wake up 10 years from now and you're unstoppable. You really know how to invest. You know how to deploy your capital. You know how to make your money, your capital work 24/7 for you. That's what you want to do over time. You want to continue to learn. So here's an ETF that invests in companies in China. All right, cool. And now I can look at their holdings. Okay, so they are buying into these companies. Now I'm beginning to see which are the top most valuable companies in China that are recognized by the US investment community. So there's a lesson for me. Here's some companies. I can go in and then examine these companies further, like Alibaba. What does Alibaba do? And now I'm learning about what they do. These guys resemble Amazon. And again, I'm learning. So when you buy an ETF, the S&P is fine, but the S&P is made up of 500 companies. The top companies are going to be the biggest ones: NVIDIA, Microsoft, Apple. And those are good businesses to study as well. But ETFs is good early and learn, and then pick out industries that are in areas that you have experiences in. For example, you're in Portugal and you probably have an occupation, right? Let's say you're a doctor or you're a nurse. Well, healthcare might be a really good industry for you to focus on because you have that personal experience in healthcare. You can understand, hey, this is how pharmaceuticals are used in a hospital. This is what patients need when they have certain conditions. That's one example. You may be in a totally different industry. You may be in, let's say, an industrial um, company. If you look around, kind of take inventory of the things that you have knowledge of. If you look at Peter Lynch in his book, and he wrote his book like 40 years ago. Yeah, about 40, 50 years ago. That guy's old school. And he really did talk about that. He said everybody has an edge when it comes to investing. Your edge is based on your experiences, where you have worked, where your family's worked, all the different things that you have experiences with. So keep that in mind that when you're new, ETFs are fine, and then try to find some industries that you have personal experiences in. That's a good place to start. And then try to learn how to value companies. Try to find a good recipe, repeatable recipe of success. Yeah, I find companies that look like this. I buy, I hold, I have exit strategy, and then I execute that plan. So although I could share that with you over the course of a few minutes, it takes a long time to get the experience, the knowledge, the capabilities, the skill sets, but don't get frustrated. Even the best investors, struggle from time to time. I would say just accumulate knowledge and keep getting better so that you're really comfortable, especially as you get older. I'm 56 and I'm good for the rest of my life economically. And I feel really confident in life, I guess, because I know how to make money. I don't I don't have to I've learned a lot to this point. I continue to learn, but I think I've got all the main fundamentals down, and I know I can take care of myself, my family, go have fun, I can travel, and that's what I would want every investor to experience. Is over time you keep getting better and better, and more capable. So thanks for that question. New investors, it's really fun to work with new investors because you're starting the journey, and it really is a journey worth taking. So Commander X, I still can't. So any company statistics above Altman PLC scores limited to subscription plan. So I'm a subscriber. Make sure I'm logged in. Yeah, I'm logged in. So let's go to Amazon again. We're going to go to statistics. Here we go. So this is the Altman score. PLC score. So here they are. So Peter Lynch fair value, he's saying $153. We're at 213. It's priced a little too expensively. I'm probably agreeing with Peter Lynch. And then Graham number, wow, Benjamin Graham would not have liked Amazon. Benjamin Graham, he wrote his book like 100 years ago. Not an exaggeration. He was like back in the Great Depression era guy. So that is interesting. Thanks for pointing this out. I'm going to start referring to this going forward. Everybody learns something every day, right? I just learned something. Thank you. And I really like stock analysis. This website doesn't pay me a dime. I found it, and I like that they don't flood all these nicely put together screens with advertisements. Like if I go to Yahoo Finance, geez, I just get flooded with advertisements, and it kills me. So I really like the layout, and you can tell that they're continuing to just bring great value to the users of it. I subscribe to it. I pay a fee just like everybody else. I'm gonna start referring to this. My evaluation of Amazon is similar. I'll show you what I've. Peter Lynch would say it's priced 28% too expensive, and I'm 32. So Peter Lynch and I are in the same neighborhood on Amazon. Now I own Amazon. I'm going to keep Amazon. I'm not going to sell Amazon. Make the numbers a little bigger for you, and not selling Amazon. So, but I'm going to start referring to that. That's interesting. And Peter Lynch, a couple of things that I'll say about Peter Lynch and then Benjamin Graham that are worth noting. So Peter Lynch, during his day, like he was really good in the 80s, and he started to fall off in the 90s. And you hear of back in the day, these super investors would be managers of a mutual fund, and the best mutual funds would attract the most money. People would deposit capital into those mutual funds, and then the fund manager would make more money because they're charging 1% on that money. And the best mutual fund manager for like 10 years was Peter Lynch. He outperformed everybody. And he had a very down to earth way of looking at companies. He did not have a finance background. He worked at Fidelity and I forgot what his education was in, but it was not in finance. And he observed that, hey, the people managing funds, it seems like it's something that I'd like to get involved with. So he became an analyst and eventually became a fund manager. And he had a couple of things that I'll cite from his book. The thing that I appreciated about him was he did look for growing businesses, but he recommended that people invest in things they understand. Now, that's not a new idea, but he really talked about how everybody has a sphere of knowledge and expertise. Everybody does. You can't have a journey in life without knowing a few things. If anything, you like certain sports, you like certain entertainment, you find certain things to be interesting. You may be an automobile enthusiast, you may be an enthusiast of, you name it, science or something. And that itself gives you an advantage. That's a knowledge advantage. What I really did like about his book is he said you got to study yourself and study where you have a knowledge advantage. And then you go look for companies in that sphere of knowledge. And I really think that's a good idea because it seems like a lot of people invest purely by following other investors. And that may be uh, successful, but limited because, if you're just following the herd and the herd has a bad year, you had a bad year and you're not learning anything, as opposed to if you really feel like I really know two sectors really, really well, just dominate those sectors. You know when to get in, you know when to get out, you know which companies are good, which ones are bad. And in other sectors, you can invest more of playing the field. So I got that out of Peter Lynch, out of his book. Benjamin Graham is totally old school. Um, In Benjamin Graham's day, 100 years ago, like financials were published in a book and published once a year. You'd go to the library and you'd go through a book and go, oh, I want to look at, let's just imagine Amazon was traded 100 years ago, which it wasn't. And you go through this book and access the financials of Amazon. Now everything's real time. It's like as soon as they announce their earnings, we can see their financials. Just access to information is incredible. But Benjamin Graham back in the day, so information was slow to get to investors. So his methodology was very focused on true valuation based on cash flows. And he specifically liked the technique, which was, I think he referred to it as unspent or unused cigar butts. If you have a cigar and maybe it's, I don't know, a cigar guy, but I guess it's about 4 inches, in length. And his analogy was to find cigar butts that were partially consumed, maybe 2-3 inches of the cigar butt was consumed, but there's like 1 or 2 inches left. Referring to a business, it's a business that the market has deemed, well, they're not as good as everybody else, and it kind of gets thrown away. It's a cigar butt that was only half consumed and gets thrown away. And he gets that investment at a severe discount, and then he rides an appreciation curve because there was a lot left in that business. That was one of the techniques that he liked to follow. One of the disciples of Benjamin Graham is Warren Buffett and Charlie Munger. Those guys were Benjamin Graham guys. I'm not a Benjamin Graham guy. I read the book, get the book, understand the book. But back in their day, what's interesting is 100 years ago, railroads were a lot like the internet companies of today or artificial intelligence companies of today. Back in that day, the companies who were controlling the railroads were in essence given these monopolies or oligopolies of being able to transport goods far more efficiently over long distances. I'm in Texas. I'll give you an example. The stockyards, we were there yesterday and I went by the Stockyard Museum and I talked to one of the historians. And the heyday of the stockyards in Fort Worth, Texas, were from basically 1900 to 1955. And it was access through the rail system that provided that competitive advantage for the stockyard to be in Fort Worth. The three main stockyards in the United States, according to this historian, were Fort Worth, outside of Kansas City, Kansas, and Chicago. All three locations had access to the rail system. It was that important because the cattle were processed and then the beef was put into rail cars and then they were transported around the country. And nowadays, it's still super important. Goods get shipped from China to ports in the US, and then they get distributed throughout the United States. Now, back in Benjamin Graham's day, they were still building out railroads. The railroads started to get built in the 1800s, but they were still being built in the beginning of the 20th century. So Benjamin Graham's day, he would actually be an investor and I guess high growth, big idea investing in that day was railroads. So the reason why I don't completely follow the Benjamin Graham methodologies is I think it was a completely different world back then. It doesn't match. When I look at my investing today, I don't even follow Peter Lynch a whole lot anymore. I think he has some really good lessons there. I don't follow Benjamin Graham very much. If anything, I just look at discounted free cash flows, but he didn't invent that. He just followed it. I would probably say that probably the guys that I learned the most from, number one, Pat Dorsey. He invests. When I grow up, I want to be like Pat Dorsey. He invests like exactly the way that I invest. He looks for companies that have really strong competitive advantages. They have advantages like Microsoft that they can keep competitors out. What's that? Why is that important? It's one thing for a business to be really profitable and be growing today, like this year. They grew really nice. They made good profits, really good free cash flow. But if you don't have these competitive barriers, these moats, other companies are going to observe, oh, you're making all that money. They're going to come into that market and compete against you. So having strong moats is really important. Moats could be patents. They could be network power, meaning you're so darn big, everybody just uses you as the standard. For example, Microsoft. I'm using right now to stream a PC. Every PC made well, not every is a big word. Most PCs that are made have to use Windows as our operating system. Microsoft just made money. So just about every PC that gets made has to pay Microsoft money. That's a pretty strong advantage. Probably most people use Microsoft Excel, so the knowledge keeps people using Microsoft Excel, and that's why Microsoft continues to grow. And they have other products that have that competitive advantage. As opposed to Hewlett Packard, their revenues have been contracting, going down, and they made a lot of money back in the day with printers, printing paper, and they were probably the best printer in the market. But they had a lot of competition, and the consumer changed what they like doing. They, in general, we went more digital than, paper print, and their businesses really suffered. They also produce PCs. Well, they have a lot of competition there. So Hewlett Packard is an example of an undesirable business. So back to the way that I invest, to define it, Pat Dorsey really wants to invest in companies that have a competitive advantage, and he looks at free cash flows, the ability for that company to produce free cash flows. Because every investment, and this is the way that I like to think about it, because it's almost like, in my journey investing, as soon as things really get it, is when I really get confident. I really just go all in on the area of knowledge. And I actually, real estate investing makes more sense to me than stock investing. It's easier. Real estate investing, and I'm a real estate investor, is simpler than investing in Amazon. Let me give you an example. I'm in California, so I'm going to use a real estate property in California. So you buy a house in California. Your intent is to rent it. You're going to rent it for $4,000 a month, maybe $5,000 a month. So you're going to receive $5,000 a month, $60,000 a year. You have that cash flow coming in, and you have expenses. And the expenses would be maintaining the property, interest expense. You have all these expenses. And at the end of it, you might say, I spend $4,000 owning the property, and I get $5,000 of rent. So I have net positive cash flow of $1,000. Bingo. So at a purchase price, you can see a purchase price go up or down, and it'll affect that model, whether you're cash positive or cash negative. If you went to a property and you saw that, hey, I'm going to be cash negative every month by $3,000, you're like, I don't like that property. I don't want to be cash negative for 10 years at negative $3,000 until I finally have a break-even point. That'd be a terrible investment. So that's where cash flow really is clear, is in real estate investing. But back to stocks. What makes stocks harder is stocks are not quite as easy where, hey, you have a property, they're going to pay you $5,000, your expenses are $4,000. No, you got to examine their financials. You got to see what their cash flows have been historically. I look at trailing 12 months. And then you need to put your thinking hat on and think about how are they going to grow in the future? Are they going to grow quickly? And there's a lot of factors that come into that decision. If you follow my channel and we go through and value companies over and over again, you start seeing the inner workings of how I make those decisions. But it's important for you to kind of follow the process, and then you take on the process and you do the thinking when you make decisions on your companies. But for example, I'll follow through on Amazon. Why do I think Amazon's going to grow cash flows by 20% over the next 4 years? Well, one thing that affects it is they're in a mature, I should say, their business is quite mature. They're big, they keep getting bigger, but they're fairly big. They're very efficient. The money's rolling in. They keep growing their business. So I think they're going to grow their cash flows by 20%. That's a decision I made in this model. Terminal value is all the cash flows after year 4, and that's a good decision. I think Amazon's going to grow faster than other companies in the economy. They'll grow faster. And then discount rate, this is based on market interest rates and what rate of return you want out of this company. So this is the cash flow. This is what Benjamin Graham, this is what Peter Lynch, what Pat Dorsey, this is the DNA of a good investment, is knowing how much cash is that business going to produce. You got to learn this. To be a good investor, it needs to be second nature. You need to understand it. Like if there's any baseball players out there, when you play baseball for so long, you put on a baseball glove, it's a part of you. You don't even think about it. You don't even think about how to catch the ball and so forth. You're seeing a grounder, you just know the technique you're supposed to follow. You just do it. It's second nature. You need to study analyzing free cash flows until it's second nature if you want to be a great investor. It's a must-have. If you don't have that skill, you're going to have a ceiling on your ability, because you can't look at a company and understand it without understanding free cash flows. So if you're new and it's like, whoa, that's going to be hard, you're right. So it's not something that you need to learn overnight. Maybe, and I'm not exaggerating, over the course of a couple years, it'll continue to make more sense, become more intuitive, and you'll get there. You just got to stick to it. Continue to see examples on it. Continue to do the arithmetic until you understand the arithmetic so well that you understand and you can apply it in real life. So this is where Pat Dorsey takes competitive advantages, barriers, ability to generate cash flows, and then he wants a discount, right? So Amazon fits all the criteria, except it's being priced at a premium. And part of it is because temporarily they've been investing a lot of capital in their data centers. I hold Amazon. I'm not selling Amazon. I'll probably buy some Amazon on dips. But that's where Pat Dorsey, if you read Pat Dorsey's book, he has a very good book. Pat Dorsey's book, in my opinion, is the modern day book that a Peter Lynch or a Benjamin Graham would have written. That's where I put him. The other investors are good. Like David Einhorn is really good, but he hasn't written a book. He's not as generous with his strategy as Pat Dorsey. Pat Dorsey, his reputation. If you're familiar with Morningstar, and Morningstar is not as influential as they once were, but 20 years ago, 30 years ago, Morningstar was the most trusted um, firm to make opinions about mutual funds and stocks and so forth. And Pat Dorsey was the #1 analyst at Morningstar. He was good. He was accurate. His team was the best. So he really knows this stuff. So he has that background. Then he started to manage his own fund and his own, I should say, hedge fund. And he's been really good. This year, he's having an off year, but study the last 10 years. He's one of the best. He's crushed. His 10-year rate of return is, in my opinion, better than anybody's. And of course, you have Bill Ackman. I just saw an interview of him that one of our members put up in the Discord. He's totally into free cash flows. I don't learn as much from Bill Ackman because he doesn't like write books that are just completely transparent about his strategy. Howard Marks is excellent, but he's a little so. And I say this with respect: is he's old school, and I think you can take a lot from the old school investors, but you got to marry it with today's economy. It's like we have companies like Meta, Facebook that are so valuable. They get more than 4 billion people to log into one of their social apps every month. That's incredible. You know, you have Google Alphabet. You're on YouTube probably watching me, and some people are watching me on X. You have these businesses that are so awesome. And this whole era came after Howard Marks and Warren Buffett and guys like that. So I kind of always take what Howard Marks and Warren Buffett had to say with a couple of grains of salt. Total respect, by the way. Michael Burry is super interesting, but I don't learn a whole lot from him. He doesn't. First, he's all over the place. He might one year, like this year, he was in China and in some tech, and he's doing really well. And then he completely sold his portfolio and just has Estee Lauder. It's like, wow, what strategy is he following? That's totally like oddball. He's not afraid to be an oddball. David Tepper, total pro. He's really good. But I can't learn a lot from him. He doesn't publish books. So Pat Dorsey's my guy. I encourage you to read his book. I think it's called The Little Book on Stock Investing. Excellent book. Easy to read. Easy to understand. Really good book. All right. So David Jackson. Hold on a second. I'm behind on comments here. So Shadow Guy. Cool. Thanks for putting in your comments, Shadow Guy. And David Jackson. Joe Greenblatt method. Yeah, we looked at Abercrombie and Fitch on Thursday, and we did a full analysis on it. Let's take a look at that one again. And it was another member that wanted to look at it. I think it was Blocks for Fun. And the valuation's good, but this is the company that their CEO was accused something horrible, like he was a pedophile. He was accused of being a pedophile and some really bad, nasty stuff. And it came out in the stream. I didn't first, at first I didn't know that. And then somebody in the chat said, hey, this is where the CEO had that type of baggage. And they were like, oh, that's why the stock is sold off so much, right? Sold off really dynamically. I've never invested in Abercrombie and Fitch. So we were looking at the company and realizing, hey, this company is discounted. It looks good. this is where you got to put your thinking hat on, right? It's discounted by 48% based on cash flows, good cash flows. The stock is really depressed, down 52% for the 1 year. And you're saying Joel Greenblatt threw up on Abercrombie. Yeah, I can understand that. When will this company get out from under this dark cloud of controversy? I don't know. I'm a stock investing guy. I'm not a PR guy. I don't know. I don't know if forever this company is going to be, held accountable for that. I don't know. But I could tell you the fundamentals show that this business is doing really well. The other thing that's interesting, right? Given that controversy, the business keeps growing. So the consumer, at least, isn't completely objecting to this company. If that has logically, right? Like if everybody was upset about the CEO, like, oh man, that guy was terrible, maybe the consumer would have said, yeah, we're not going to buy the stuff anymore. We're not going to buy the apparel anymore. And the reality is, no, they keep buying. So I would say if I continue to see that they're buying, like maybe a quarter or two, I'm probably going to be buying the stock because maybe the CEO was a bad person. I don't buy CEOs, I buy companies. And this business really has the right stuff to create apparel that younger consumers like. It's a good business. I'll be a buyer. So we'll see where that ends up. And now that I know that there's a Peter Lynch, score, let's see what Peter Lynch had to say. So Peter Lynch thinks it's discounted. Look at that. Upside potential, 206%. So Peter Lynch and I are agreeing. I'm going to have to ask about, so I do ask the founder of this website questions from time to time. He's cool enough to respond to me. I'm going to ask him, can you tell me how this gets created? And maybe I'll put that into my videos. And then Benjamin Graham thinks it's close to fair value. See, Benjamin Graham's kind of super old school. I just don't think his technique applies anymore. Peter Lynch, I'm still not totally sold on it. I think it's good, but it's closer. But look at that. He's at 206% discount upside. That's not a discount. That's upside, meaning you can triple your investment if you bought into the stock, 254. Stock's at 82. Yeah, you can triple. Where my valuation was, each share is worth $186 a share. So Peter Lynch and I agree that this is a discounted company. All right. So Joel started the magic formula investing technique, PE and return on ROI, return on invested capital, right? Yeah, I don't follow that technique. So, and let's look at return on invested capital. I'm curious to see what I think it's here. Nope, probably gonna be here. So PE ratio is low at 8. So return on invested capital is 20%. It's really good. So you want this to be high. So that looks good. I mean, every way you look at this business, and the piece that is kind of a positive observation about this business is the consumer's not going away. Yeah, there's a negative story. Yeah, the CEO is accused of something horrible, but the business continues to be really valuable. Consumers are liking the product they sell. So that's why I'm watching the stock and thinking this might be a good investment. I'm going to give it a little bit of time, maybe go a quarter or two. Next time they announce their earnings will be a ways from today. We're going to wait about 3 months because it's probably be late August when they announce their next earnings. So I'll look at that earnings, see if maybe that's a good jumping off point, or maybe even wait 2 quarters and then make a decision, or just stand pat. I don't own any retail businesses. I don't like retail businesses. And as I cited on Thursday, the reason this one's a little bit different is when I looked at their margins, I was like, wow, these are good margins. 63%, 64%. Retail is, man, it's tough. These guys are getting it done. And their inventory isn't swelled up. It's really good inventory management. They have good profit margins, good free cash flow margins. I'm like, man, the numbers look really good behind this business. Really low valuation. If, let's say, a bigger company wanted to acquire them, totally an acquisition target, they would have to pay a premium. Maybe they pay 30%, 40% premium, and boom, they have a really nice line. So really nice line of clothing, stores. So really neat little company. Caught me by surprise because I don't like retail, and this one, the numbers swayed me. I'm like, yeah, that would be an investable business. When I look at, I may still already have it. Maybe I do, maybe I don't. No, I don't. So Abercrombie, I would put like in the gray right up here because they continue to grow profitability, free cash flow. It's not like they have, I would put them like around here, meaning I have to have a very good discount, which they're providing a really compelling discount. They don't have like a super strong moat where competitors aren't allowed to compete against them. Obviously, the other competitors come in and try to sell apparel, but they have something that the consumer wants, something about how they design things. They got their finger on the pulse of what the younger consumer wants to buy with regards to apparel. So I put them like around here. So if you give me the right discount, I invest in the gray and I invest in the green, and I try never to invest in the red unless it's a really compelling, unique situation. Um, those are the zones that I invest in, and the reasons or the discounts that I'm looking for in those zones. All right, so thank you for the comments on that. Appreciate it. If there's any other symbols you members want me to look at, please pop them in the chat. All right. And okay, so the week ahead, just kind of getting my thoughts together. I'm a dollar cost average investor. I'm not smart enough to think, hey, I can nail the exact date on when the market's going to hit a low. I just know, like back to a stock, I know the stock is discounted based on what I expect they're going to do from a cash flow. So I know it would be a good buy, and I'm willing to just buy into the stock over time. That's how I invest. So as I think about my week, am I expecting the stock market is gonna continue to thrive? I would say I have like a 60% expectation that it's gonna drop. Why? Because we've been on a really nice rise. I mean, from April 8th to now, we're up 20% on the S&P. And if it just keeps going up, that'd be wonderful. But at some point, some of these stocks are getting a little too euphoric. I'm going to pick on one of my own stocks. I own Robinhood, and these guys are in a euphoric ride from April 8th to June 6th, up 119%. I mean, it's fun to look at my balance for Robinhood. Really, really neat. But I'm like, this is like eating ice cream for breakfast, lunch, and dinner. This can't happen for a long period of time. If anything, the market's going to get sick of ice cream. It's just too good. And I could point out several stocks that have this type of euphoric rise. So this is what leads me to think, and look at that, it's dropping a little bit in after hours. So, it's just a little too euphoric. So that's why I'm thinking we may see some price sells. Okay, so we'll see. So Shadow Guy, I have looked at Circle. I did look at Circle. Let me look at Circle again. Circle's a company that did their initial public offering this past week. They do stable coins within crypto. And what is encouraging for IPOs is it was a really successful IPO, initial IPO. So we'll look at Circle. And then Zam. So since I'm on Robinhood, I'm going to stay on Robinhood, and then we'll get back to Circle. So here's where, so for Robinhood on my channel, you can probably watch 6, maybe more videos that I've published on Robinhood. And the videos go back a couple years. And if you study the videos, in essence, what I thought 2 years ago about the company was I really liked that they don't follow the playbook of old school brokerage, companies, old school finance companies. They're like, no, we're going to recreate the way stock investing could be delivered, could be participated by the investor. And it worked. And they broke the rules. Now all other brokerages have to follow Robinhood. They're like, and we're going to put crypto on the platform. Boom. Now they're moving into gambling. They don't want to call it gambling. They call it something else that sounds like it's not gambling, but it's kind of like gambling. And I love that about them. It's like, hey, nice job, because that opens up a lot of addressable market to them. And I think they really cater to the way that the younger investor wants to think about stocks and analyze stocks and experience the application, the software, the way it's coded for the Robinhood platform. All those things totally made sense to me. And when we look at their fundamentals, back to, hey, I'm buying Robinhood because of the expected cash flows for the future. Let me tell you, their cash flows are phenomenal. So the best businesses, I heard Bill Ackman say this in, again, a video I watched this morning. The best businesses are those that can grow, that are profitable, generate free cash. They don't have to put a lot of capital into their businesses. For example, I dislike utilities because they have to put so much capital back into their businesses. They run these big electricity producing power plants. And I guess it costs so much money to maintain these things that they have to put all the cash they produce back into the business to keep the business operable. Well, you think about Robinhood, you're like, okay, they run, I'm going to oversimplify it. They run a website, people log in, they bring their capital to that platform, It's secured. And then Robinhood's making money on fees, trading fees. They also get to take some of that capital and invest it, and they're making money on that. So they're also making money on order flow. All those ways they make money is without them having to build a big giant factory. They don't have to buy materials, rare earth materials from China, ship them across the Pacific, get them into their facility and put them into their process. No, they just have really smart developers, and they create a platform that investors really like. So very little capital has to go into the business, and they continue to grow. When you look at the growth rate for Robinhood, and I'm getting to your principal question. Let me just kind of build kind of like the conversation, and then we're going to get to what I think is going to happen in the stock. So when we look at their growth rate, really nice growth. These are excellent growth rates, right? 22 was bad because it was a bad investing year. But 89%, 245, 37, 59, 59%. Jeez. And they're above 3 billion. So looking at, are they profitable? Do they generate cash? Absolutely. Really good cash. Profit margin. This is profit margin. What falls to the bottom? 48%. They don't have to deploy much capital. So really profitable business, but the stock has just kind of gone up so fast. I still think the stock is discounted by 16%. So I just think that the stock is gonna come down because investors are gonna take profits. Some investors are gonna be like, hey, great, I tripled my money, I doubled my money on Robinhood, I'm good to go, take my profits and move on. So that wouldn't be a bad thing if we see a nice pullback of 20%, and it allows for investors that are in it for the long haul to buy more shares, like myself. It wouldn't be a bad thing. And I would expect that hey, we're going to have some of a pullback. This is the example I used on where I think the market's too expensive, because you're seeing some of these crazy moves. Year to date, it's up 100%. Seriously? If we look at the 1 year, it's up 219%. It's like, yeah, it's a little 2-year fork. That's going up too fast. So those are my comments on Robinhood. So fundamentally, it's a good business. I'm holding, waiting for a solid pullback to buy more shares. I'm not selling my shares. It's I think at this point it's a 5-bagger for me, so I'm good, and love for it to just keep going up. Their strategy hasn't changed. I love their strategy. Their fundamentals and their execution look great. It's one of the bigger successes I've had in the last 2-3 years. Great. Meta's up there. Uber's up there. United Healthcare's up there. I bought United Healthcare like 10 years ago. Held it, sold it, made money. TSM, similar. So Robinhood is an idea that really worked. Thanks for asking, and thanks for your support of the channel. All right, let's talk about Circle. Now, when we were looking for Circle on, it still isn't on there. Google still doesn't have Circle on there, but Stock Analysis does. Or maybe it doesn't. There it is. All right. Okay, so Circle, they had an IPO price of $31. They're trading at 107. So it's only traded for like 3 days, I believe. So the data's only been out there for like 3 days. So these websites have a hard time figuring out. Here we go. Started trading on the 5th. traded for 2 days, not even 3 days, and you'd be up 247%. Awesome. Now that's what you call a good return on investment, huh? And Circle has a logical business. Now let's look at their financials. And when I looked at their financials, I think my conclusion, I don't know that I have Circle yet. And my conclusion was that I just don't have enough data. There's no way I can get to their valuation. Right now, they're a $24 billion market cap company, and they're just red hot. Investors are so crazy about this stock. So let's go over the fundamentals, and then I'll go over why I don't buy IPOs. So I'm not going to touch Circle. I'm going to wait a year, maybe a little longer, until I have more data and I really know what these guys are going to do. I don't have to like catch a lightning in a bottle. I don't need to do that. In this stock, I'll show you other stocks that are obvious successes, and shortly after their IPOs, the stocks crumbled and then they started to go up again. All right, so back to Circle. The revenue has been growing well. They've had some years which just took off, and not sure why it's 983. Comparing 23 to 24, it was 15% growth rate. And if I compare this number versus a trailing 12 months, it should be 19, should be about 15% as well. So 15% growth. That's not like, whoa, my head's exploding level of growth rate. That's actually underwhelming. I showed you Robinhood. They're bigger, more than twice as big. They're growing at 59%. So 15% is not like, wow, man, this is incredible. No, not incredible at all. So take a look at other fundamentals. So they are cash flowing. That's very good for a young business to cash flow. These crypto businesses, they don't have to put a lot of capital back into their businesses, right? It's basically they create a platform. They can mint. I think that's, what's the right word for when you create a new stable coin? Let me ask my son. Hey, when you create a new stable coin, is the right word to say is you minted a new coin, or you released a new coin, or you developed a new coin? All right, we don't know. I'm going to use the word mint because that's what you do with, you have regular currencies, fiat currencies, you would mint new coin. So you don't have to put a lot of capital in these businesses, which is interesting. Gross margins are good, given that they don't have to put a lot of capital in the business. And their free cash flow margins are very good. So if I were to take this number, 300 million, multiply times 50, I get to 15 billion. Now that's like, wow, if they really make everything work, they're gonna be cash flowing at some point. On a per year basis, they're gonna be probably cash flowing 1.5 billion. Okay, so that would be like the maximum valuation I can imagine, and they're at 24. So it's like, wow, man, it's kind of expensive. Balance sheet, I'm expecting that these guys are going to be sitting on cash because they just IPO'd. Yeah, they got, but this is, okay, you got to look at the cash, the balance sheet, because crypto businesses, the way they have to report their financials is based on generally accepted accounting principles. And those were created with the paradigm being businesses that existed 50 years ago. Crypto had nothing to do with 50 years ago. Having said that, you see these categories, right? Like Yeah, they have cash, but a lot of that cash is held to back up the stable coins that they're minting, right? So it's not necessarily cash. It's not like they could buy another company with it or something. So you have to study the balance sheet really closely so that you don't misinterpret those balances. So there's cash there, current assets. Current liabilities. Here it is. So you see how the cash almost matches the balance to current liabilities. And we'd have to go to the website to see their balance sheet, but it's probably because, yeah, we collected this cash, but it is liable for a coin that was minted. This cash has to go to that coin should somebody want to redeem it. So it's not cash they can freely use. So that's what I put out there. So I'm back to this business. Best case right now I could see is worth like 15 billion, and it's way over that mark. Now let's look at Robinhood. This is obviously a success story, but look at this. They IPO'd, screamed up, and then they came down like a lead balloon. And man, did they come down. Market was like, oh, Robinhood's terrible. They're horrible. And they sold it off by 84%. This tends to be the chart for most IPOs. They come out, they're red hot, a lot of like excitement, and then the big investors cash out and they're like, okay, we'll see what happens. And a stock will crash down. Well, here's where I like to invest. This is where I invested in Robinhood. And then you just ride up if you believe in the business, you make a killing, right? Later on. But I could show this. Coinbase is probably the best example to use for Circle because Coinbase, come on now, man, Google's got to put a couple more servers online. It's just not keeping up. Just look at Coinbase. Similar chart, right? Coinbase came out with a lot of fanfare. Oh man, these guys are awesome. And the market sold them off by 90%. Holy smokes. Now, if you bought then to now, you made a killing. I'm waiting for this zone for Circle. I'm interested in Circle, but I'm waiting for this zone. I don't want to buy here because, boy, that's a painful ride down. And the same thing with Robinhood. That was a painful ride down. I'm going to go to Palantir and see what their chart looks like, the max chart. See, they came out with some fanfare, sold off 75%. And then from there to here, oh man, Palantir stockholders are like so happy. So that's how I'm going to go with Circle. I got to give it some time. Give it a year. Give it a year and a half. Probably give us some better fundamental data. If stable coins are a thriving business, it'll show up in their financials. If it's not, it's going to show up in their financials. And then we have other businesses. I think Kraken's going to come out, and other businesses that are in the crypto industry are going to come out. So those might be better investments. I don't know. So that's where I'm at with Circle. Thanks for asking, Shadow Guy. All right. Rotel and Cheese. Good to see Joey. And Joey, happy to look at it. $5 for non-members if you want me to look at a stock, or you can become a member and then I could look at stocks that you request. And Rotel and Cheese, good to see your comments. Yeah, you might be right. The Tether is the leader. I agree with that. Go Bills. That like Buffalo Bills? Maybe. Yeah, and if you want me to look at MDT, I think is that Medtronic? $5, I can look at it. Or if you become a member, I could look at stocks that you you put up there like Gmail, Zam, your recommendation on it some time back. Really good, but nice. I'm glad that's working out. Reddit, man, I don't know. Sometimes, the market it's so interesting that the market is irrational at times. And this stock hasn't been around a whole lot, but the stock went up, and then the market's like, no, we don't like it after all, and it sold it off by 61%. And this is Reddit. You look at their financials, the financials look really good. And there's stories out there that, the Google algorithm isn't going to be as great for them. All right, that's fine, but they're growing 64% after that story. It's like, which one is it? Is the algorithm going to hurt them? Well, geez, they're growing at 61%. That's not all that bad. So I look at this business and I see their growth. I understand Reddit to some extent. I'm a user. I think that their user base is pretty darn solid. Very, I don't know if loyal is the right word, or really like using Reddit. I don't think they're going to go away all that easy, because it's not a platform that gets replaced by somebody else. It's not like Facebook does everything that Reddit can do. No, that's not the case. So I really like their business model, love their growth, and I think their business is going to be worth a lot more in the future. So right now it's discounted by 19% because it's seen a nice little rise recently. When we look at, let's go the monthly from May 21st to now, it's up 26.5%. That's nice. And I think this one's going to keep going up, man. Just Reddit's got a lot of addressable market. It doesn't have any like true competitor. Like Facebook isn't going to compete against it. Instagram, TikTok. I think the users are going to continue to use it. And I think internationally, more users are going to come into the Reddit app. So I'm going to keep buying into Reddit. So thanks for the comment. David Knight. Yeah, I can take a look at Micron, $5 super chat, become a member, and you can bring that up on live streams, bring it up on member calls. We can talk Micron. Irvin, thanks for joining. Cool. Man, good live stream, everybody. Sunday morning, that's when a lot of action in stock investing. A lot of people trying to figure out how to make some money on stocks this week. So Jeff Ha, when I look at Zim, happy to $5 super chat, become a member, and then you can ask for Zim to be analyzed. It is a stock that I've analyzed and have a lot to say about. All right, everybody. So I wanted to stream because this week's going to be a real busy week for me. I don't know if I'm going to be able to stream again until like Friday. So just letting you know, there's probably going to be radio silence on my streams for about, I guess, 5-6 days. But I'm going to be having my member calls. So for the members out there, we're going to have one a little later this morning, midday, I guess, for people on the East Coast. And look forward to talking to you guys, seeing what you guys are up to, seeing if we can get into conversations that'll help you organize your trading week. And if you want to become a member, super easy. I think you get a lot of value from it. You just go to my channel homepage. There's 3 different options. You can take a look at the one that's right for you, different perks at each level. And I think it's really worth it. And the valuation model that I showed, you get an example of it so you can start working on your own valuations. You can ask for tickers to be evaluated on live streams. We engage on Discord. You can ask questions of the community on Discord. I think it's a really good place to learn. So consider becoming a member. It'd be great to have you, especially some of the names that I've seen forever. And I've seen your comments. I'd love to just get more of your participation in the community. So consider becoming members. All right, everybody. So let me wish you a nice Sunday. If you're a basketball fan, I hope you enjoy the NBA Finals. I'm going to enjoy it. See if Indiana can shock the world again and beat the Oklahoma City Thunder. I think the Thunder is going to show up because they know that if they lose the second game, it's going to be really, really tough to overcome a 2-game deficit. But it made the series far more interesting. And everybody have a terrific week with your trades. Good luck. Thanks for tuning in. And I appreciate it. Good luck. Bye.